welcome to Wealthion. I'm Wealthion founder Adam Taggart. We often discuss hard assets on this program as an investment category that can offer protection against the ravaging of purchasing power that inflation causes. Gold, silver, energy, agricultural goods, real estate, and farmland are frequently mentioned, but one we've not discussed before is diamonds. While in total valued at more than all of the silver, platinum, and palladium in the world, diamonds have historically been a tricky investment due to their variance, because no two are exactly alike. Today, we learn from Cormac Kinney how his company, Diamond Standard, is solving that challenge by creating a regulator-approved solution that finally makes the $1.2 trillion diamond market tradable for both institutional and retail investors. Cormac, thanks so much for joining us today.
It's great to finally meet you.
Well, thanks so much. I know we've been talking for a while, having you on the program. I'm glad we finally were able to make it happen here. All right, so I know little about the diamond industry coming into this interview, short of the stressful process I went through when buying my engagement ring for my wife. And I'm guessing that many other viewers feel the same. Can you explain to us how the diamond market has conventionally worked and why it's been kept outside of the public markets where many other of the assets I listed in the introduction trade?
Yeah, so it's funny. I'm not from the diamond industry. I kind of accidentally learned way too much, and my background's computer science, and all the complexities of diamonds to me seemed like a computer science problem. So that's how I got pulled in. But diamonds are this extremely interesting asset because, as you mentioned, they're extremely valuable. And since the days of the pirates, plundering each other's, the king's diamonds, diamonds have always been this very valuable natural resource. But the problem for investors is diamonds have always been out of reach because, like you said, every diamond is a little bit different. And so there was no price discovery mechanism. We list securities, we list commodities, and the market tells us every day, what are they worth? With diamonds, that never happened because every diamond's a little bit different. And as a result of that, the friction of trading a diamond was always immense. And it was always through these experts, and people would estimate the value and then all these retail markups. So long story short, an institutional investor could never invest in a diamond because they could never mark to market. And if you're a BlackRock fund, for example, you need to mark to market every day, whatever you're holding. And without that transparency, without that liquidity, you simply could not have diamonds in any kind of institutional portfolio. And that's what attracted me to the asset.
Okay, so I want to dive into sort of how you are making it approachable or accessible for the institutional investor, but I think also there's an opportunity for the retail investor here too as well.
Definitely. Great. Absolutely.
Okay. Before we get there, let's just stay on the conventional side for a second. So today, how are they bought and sold?
Yeah. So the diamond industry is like a giant triangle, right? And at the top of this triangle, you used to have only De Beers. And a lot of people heard of De Beers and they hear this is it a cartel? Is it a monopoly? And a long time ago, yes, it was. Back in the 70s through 90s, De Beers controlled 85+% of the diamond supply. They've long been broken up. And today they control about 20%, and they don't even own those diamonds. They distribute them. But at the top of the triangle, there are only about 9 diamond mining companies. Names like De Beers, which is owned by Anglo American, a public company, Rio Tinto, Dominion, Petra, Lucara, and notoriously Alrosa, which is the Russian diamond company. But those 9 companies, they dig up all the diamonds, and there are about 300 companies called site holders. These 300 companies buy all of the rough diamonds, and they generally have an auction process or a tender process where every month they sell whatever diamonds they dig up. So it's a myth that there's a giant stockpile of diamonds managed by De Beers. Because they're public, we know that they sell all their diamonds within about 60 days. That's their
Oh,
supply.
wow.
The fat part of the triangle is there are about 40,000 middlemen. And these are all the brokers and traders and dealers that buy the polished diamonds, and they may group them, they may sort them by grade or by color, and then they sell them throughout the world to jewelry manufacturers, to jewelry stores, and to consumers. And so at the very bottom of that triangle are all of the consumers, which include jewelry manufacturers, obviously turning diamonds into jewelry, and all the diamond stores. What we've done is we've radically upended that the middle market, all the brokers and traders and dealers, by establishing the world's first electronic diamond exchange.
All right. That's really fascinating. So it sounds like you've got these few big players at the top. You then have, you said, about 300 companies that buy all the rough diamonds from them. Then there's about this 40,000 ecosystem where I'm assuming they sort of refine the diamonds or get them sort of near final state. And then you've got this whole retail manufacturing and sales side, which is, just more and more people, more and more hands getting their cut as we go through this process here.
That's a great word. It's actually, there's 5.5 hands on average between the mine to the wife. I like to say it's obviously more than wife. 5.5 hands on average is what it was before Diamond Standard.
Okay, and I'm curious, what would you say you get the number of hands down to in your system? Three. Okay, good. So you're taking 40+% out here.
Yeah.
All right. So let's get to your solution here. But real quick before we do, what were the key issues that you were trying to solve by founding Diamond Standard? You talked about there was no mark to market. There's obviously this variability issue that we talked about, the lack of uniformity, I guess, if you want to call it that. What were sort of the other key pillars that you built Diamond Standard around to fix in this conventional model?
The main one is friction. So you need price transparency and low friction to have an efficient commodity. And so it really all came down to one singular focus, which is that what the world needed was a fungible diamond commodity, a commodity that they're all the same, and therefore you can discover what's the value of this on a daily basis. And that spot commodity can be the basis for not just spot trading, but also futures, options, exchange traded funds, and the holdings of institutional investors that could be marked to market on a daily basis. So our focus is, how do you make a fungible diamond commodity?
Right. And so this would be the equivalent of an ounce of pure gold, right? So, okay, everybody pure gold at 0.99 is pretty much right. Trying to give the investor that kind of confidence that says, when I buy fungible unit X, I know that it's the same as the other fungible unit of diamonds that you're offering. Yeah.
In fact, at exchanges, there's what's called a good for delivery bar, and it's not 1 ounce. It's in the US, it's 400 ounces.
Right.
And that's the standard bar, for example, that you deliver to a CME counterparty to sell a futures contract. We've created, and we have the regulatory approval for the good for delivery bar for diamonds.
Okay. So let's now kind of get into what you have created. You've created a good for delivery bar for diamonds. It sounds like from reading your website and whatnot, you guys have also created a good for or a coin that is also a fungible unit.
Also good for delivery.
Also good for delivery.
You need more.
Pardon me?
You need a lot more. So in our futures contract, it's settled by 2 bars or 20 coins, or 1 bar and 10 coins. But they are fungible. Even the bar and coin units are fungible through the magic of math.
Okay, so a bar basically equals 10 coins here. Let's actually talk about these bars and coins. Like, what exactly are they, and how do you make them fungible? How do you make them equivalent?
Yeah, so this is what they look like if you haven't seen them.
All right,
These are
I'm
diamonds.
guessing those are the coins.
These are diamond standard coins, and these are diamond standard bars. You notice the diamonds are much larger in the bars than they are on the coins. You can also see the diamonds in there. You also see a white layer. That's a computer chip that's built into the commodity. But the breakthrough is that these two bars are equal. They're not identical. They don't have the exact same diamonds, but the diamonds in every bar, they have different carat weights, color, and clarity for each diamond. Those always add up to a public standard that's always the same for every bar, and they always represent a statistical sample of all diamonds. And that's and we can go through the process, but it's pretty cool computer science breakthrough that an optimization system in automated market making forces every coin to contain an equivalent set of diamonds. And it's based on geology. As you mentioned with a gold bar, you have to have 400 ounces. It has to be 99.9% pure. That's a geological standard. You don't put $1,500 of gold in every bar. You have to put 400 ounces. And we developed that exact same approach for diamonds. We have to put a very specific geological scarcity into every coin or bar. And I say scarcity because it's not the same weight. You might have one bar that weighs half a carat less, but it might have more color, for example, or it might have more clarity. So there's a optimization process that takes place.
All right, fascinating. And for folks that are wondering, look, we're going to get to a discussion later on in this interview about the role that when you talk about geological scarcity, the role that like lab-grown diamonds and whatnot may play here. I'm presuming you've got a good answer to that. I see you nodding as I'm saying this. So for the skeptics out there, we are going to get to those questions, but first I want to continue sort of understanding the actual products here. So super interesting, Cormac. And so it sounds like you talk about creating a standard, geological standard. I guess that's why you named your company Diamond Standard. So it sounds like the key dimensions, and again, let's review them for folks. It's clarity, it's color, it's carat. I'm trying to remember
Those are the main ones.
Cut probably doesn't matter very much, right? Because it's just aesthetic.
No, it does. Well, the aesthetics count a lot because the only demand for diamonds really is for jewelry. So we could not ignore the cut because the gem cutters will cheat. If they're allowed to make an ugly diamond, they'll make it as big as they can and cut out the imperfections. And so it'll be a big, ugly, flawless diamond, but it won't pass the cut grade. So cut's very important. And there's also minor factors like fluorescence, shape that have an impact on the value of a diamond. So our optimization system actually is able to harmonize across all of those characteristics.
Okay, so when you talk about your optimization system, then my guess is you've got some sort of score that sets the standard, and it's comprised of each of these different factors. And like you said, one bar coin might have more diamonds that collectively have more clarity than another bar coin, but that's being balanced out by one of the other factors. So at the end of the day, when you add up the totality of all of the inputs, it equals up to that exact same total score setting the standard. Is that true?
Close. And it's kind of interesting. That was how I first approached it. And right behind me, there's a Wall Street Journal article from last week where they talked about this challenge. I was a quant. I ran quantitative strategies for Paul Tudor Jones and for Millennium. So I thought, I could analyze all the diamonds and come up with a pattern or a recipe and then replicate that. And it turns out that, diamond prices change all the time and people's preferences change all the time. So our process is actually more of a brute force Adam Smith model. If you remember the invisible hand, And what we do is we force the market to tell us the value of every diamond. We have no algorithm. We have no opinion on the value of diamonds. And we always buy the diamonds for our clients. We're an agency. We make a fee, a 3.5% fee, but we don't have a dog in the fight for diamond prices to go one way or another. So maybe it'd be helpful if I explained the process.
Absolutely.
And we'll look at a couple charts. But the foundation of the whole concept is this fungible unit, right? The coin and the bar. And the diamonds are inside. Every coin contains an optimized group that add up to the standard. And what you'll notice is that the diamonds in the coin are all smaller than the diamonds in the bar. And if you look at the range of diamonds that are permitted, we actually can use about 94% of all varieties of diamonds that are gem quality. We don't use pink diamonds and blue diamonds and yellow diamonds, but those are very rare. We don't use, 5-carat Cartier diamonds, and we don't use tiny little diamonds that are too small to have independently graded because it'd be too expensive per unit of value to grade them. But everything in these wide fence posts of anything from 0.18 carat to 2.05 carats, that's a giant range. Anything from flawless diamonds down to I1 diamonds, and everything from D color down to L color. And also the cut has to be very good or excellent. But everything in that range, every combination of carat weight, color, and clarity, we can use. That turns out to be 16 million different types of diamonds. One diamond might be a 0.45D flawless with an excellent cut. That's one diamond. And the breakthrough for us is that because we could use 94% of all diamonds, that made us a natural market maker. We were willing and able to bid on 94% of all diamonds. And that's exactly what we do. That's the brute force I'm talking about. So as a market maker, we were able to build the world's very first in history electronic diamond exchange because we could force that price discovery by bidding until we were able to buy. So what this first chart shows you is all of our bids. And as you can see, we bid on every variety of every combination of carat weight, color, and clarity. Now, we're not stupid. We bid low like any other marketplace, but we're also on a forced march. We have to selectively raise our bids until somebody says yes. And we had a huge breakthrough in computer science breakthrough in automated market making because our system makes about 16 million bids a day.
Wow.
On all these different types of diamonds. Each diamond is its own centralized limit order book. And essentially we bid until someone in the world says yes for every different type of diamond. We have to buy on a weekly basis at least 10,000 diamonds. So this scatter plot shows all of those bids. This next slide shows the result of us raising our bids to however much is needed so that at the end of each week, we buy a statistically valid sample. What we're actually doing is through bidding and market making, we're forcing a scatter plot that represents all diamonds consistently. So we have a little bit of every carat weight, color, and clarity. That sample, the best way I've found to explain it is that if you imagine every week I buy 10,000 diamonds and in a pile like this, and the pile this week could never be the same as the pile last week. There's a infinite combination of diamonds. However, if you take out all the colors, you'll see that the frequency of every color statistically is the same for every pile. The diamonds we buy today and the diamonds we buy in 30 years will have the same frequency of decolor, which is 1.27%. If you take out all the flawless diamonds and say, what's the median carat weight, or what's the distribution of carat weights, these statistics of every pile are always identical. The geology, the aggregate geology of every statistical sample is permanently identical.
Got it. You're letting the laws of large numbers work here for you.
Exactly. We love the law of large numbers, and we need it because that sample, every week we make it public. So nobody trusts us. We have to prove to our regulators and to our auditors like Deloitte that every time we buy diamonds, we forced the market to price discover, tell us this is the cost of literally every possible type of diamond. And then we end up with a statistically identical sample that our optimization system divides into the coins and bars. So this last chart shows you what we've discovered is the yield curve of diamonds, similar to the yield curve of bonds, but in our case, it's the yield of the earth. How frequently does the earth produce flawless diamonds or G color diamonds? That curve shows how the increasing in scarcity as diamonds get larger, as they get more flawless and more colorless. Our optimization system, and this is another breakthrough because it's non-linear optimization and what's called integer programming, because each diamond is an integer. You can't put a half a diamond in a coin. But our optimization system divides that pile so that every coin contains a yield curve. Every coin has small, medium, and large diamonds, good, bad, and ugly, like the movie, etc. And that's how we're able to prove, because it's all transparent, we're able to prove that every coin is equivalent, and they always have at least 100% of this statistical standard. So it's all based on math.
Wow, that is super fascinating. I believe it or not, I think I did follow all that, and it was really brilliant. It's a great mashup of sort of the geological output of the Earth and this kind of quantitative, big data analysis that you bring to it. It's really pretty fascinating. So let me ask you this. So, when I have gone to buy diamonds, which has been extremely rare, you are basically sort of subject to the explanation of the diamond seller telling you why this particular diamond has the price tag that it has on it, right? And it's relatively difficult to go shop around and try to find a different price for that exact same diamond because all diamonds are somewhat different, right? It's relatively rare you're going to find one that's got the exact same scores on all the 4 C's. So it seems to me that I understand the efficient process you've set up there, but it seems to me that your marketplace that you've created, the price discovery that you're creating, could actually change the diamond industry now, where instead of each seller basically giving their subjective pricing on what it is, you can just go to your model and say, I've got a gem that fits these characteristics, and you would say, oh, well, then that's worth X today.
And it's not a model. It's based on this is what I paid for it yesterday.
I shouldn't say model, but exchange. Yeah.
Yeah. So we don't believe in opinions, right? There's absolutely no subjectivity in anything that we do. And I mentioned there's about 300 global site holders. 180 are already members of our exchange. So that's where we get all of our diamonds, is by bidding on them from all of these participants. But
okay,
you're
great.
exactly
that was
right.
the question I was going to go to, which is you got those big 7 or so companies that are producing the raw diamonds. Then you have these 300 folks that are buying them, and we're then sending them off into all those zillions of middlemen. You're actually now buying directly from those 300, or at least 180 of those 300.
Yeah, mostly from the 300. There's also some of the larger brokers and larger middlemen in the business. But the key step is that somebody in that top of the triangle, they're cutting the diamond, they're polishing it, they're manufacturing from the earth into the beautiful gem. that you see in a ring. And it's usually those 300 largest companies that are generally the cutters, but not always. But yeah, we have about half of the top of the industry already part of our exchange. We also have companies like Tiffany's, for example, members of our exchange that want to be able to buy next to us. So, but so far we're the only buyer because it's a lot more work to create a two-way marketplace than a one-way. But we are developing that now.
Okay, maybe we earmark this for later in the discussion because there's still some more fascinating parts about your actual product that I want to get to. But I do want to remember to ask you about resistance inside the industry of like, hey, we've been able to get away with some obscene margins here, and these guys are coming up with a true price discovery mechanism that reveals that maybe we've been charging way too much. Right?
Yeah, we are a very scary monster to the diamond industry because we're advocating transparency and efficiency. And it was actually, I know the question that's going to come up is about synthetic diamonds and lab-grown diamonds. That actually was a huge benefit to Diamond Standard, even though we only use natural diamonds that are mined. But it was the threat of synthetic diamonds that convinced not just all of those diamond suppliers and vendors to work with us, but also convinced the two largest global labs. We partner with the two largest gem labs, GIA and IGI. We actually never touch the diamonds. They're all handled inside the gem labs. And we had to convince them to risk the wrath of their clients partnering with us to create transparency. But it's because of the threat of synthetic diamonds that the industry was willing to get behind this initiative and take the risk of, similar to decimalization. Your beard is gray enough, you may remember decimalization. The whole brokerage world was afraid of going from eighths and sixteenths down to pennies. They're like, this will destroy the whole market, our margin. No, it created much more liquidity and much more volume. And those businesses became volume based instead of premium based. And they all did extraordinarily well. So we're instigating the decimalization of the jewelry, of the diamond industry. It will be painful though, because what we're really doing is disintermediating all of the middlemen, right? Those 3-4 hands that used to, sort the diamonds to get all the good ones together and all the half carats. That's done. We don't go through that, and we're deleting that part of the supply chain.
Great, but this is back to sort of the Adam Smith. This is you're an agent of market forces here, right? Where at the end of the day, you're finding a more efficient way to price. And revealing a more true price, and in many cases here, a lower price than what the consumers are paying here. So you're removing components from the chain and creating value simply by removing excess costs and friction. And overall, you should be, in theory, lowering the price of diamonds for the end customer.
Oh, dramatically. So we pass all those savings on to our investors. And I'll give you another example. We pick up the diamonds in India, in Hong Kong, in Thailand, and we consolidate the shipments, thousands and thousands of diamonds that we ship in bulk, and we handle the customs and all that shipping. Just the consolidation of the shipping and all the insurance cuts out 5% of the cost. So when we sell this coin to a consumer, you could never buy these diamonds for this price. This is 5,700. If a consumer with cash tried to buy this on 47th Street, which is actually right out my window, you'd pay $8,000, $9,000 for the exact same diamonds. And that's how we're able to preserve this low friction, because this is basically, you're always trading a wholesale unit of diamonds. You don't have that retail markup that you have to give back the first time you sell it. So that's the secret of how we make a product that's liquid and low friction.
Okay, so if I remember the numbers there roughly, so hold the coin up again first for a second. So that you said is about today's market value. That's about $5,700, correct? Okay, yes. Which would make a bar about $57,000, right?
Exactly, $57,000. It's always 10x.
I can do math. That's good. A simple math. All right. So you're saying that that coin would be worth, the diamonds in that coin would probably cost you $8,000 if you walked into sort of a retail shop right now.
No, if you walked into retail, it'd be $10,000. I'm saying if you walked on 47th Street and went upstairs and paid cash. So here's a good example.
And sorry, maybe just remind people, 47th Street is the diamond district in New York where the high volume guys who sell.
Yeah.
So if you want to like get a good deal, that's where you go. But
if you walk down that street, you won't forget it.
All right, I'll let you keep going, but I just wanted to do the simple math of the difference between 5,700 and 8,000. That's a substantial savings. I mean,
huge.
What is it? It's like a third, basically, right? Ish.
Yeah. But think of the markup. What's the markup in a retail jewelry store? They double whatever they buy. They double it for the most part. So if you were to buy this from us, it's 5,700. We make a little spread. If you were to try to buy these same diamonds at Tiffany's, it'd be 15,000. If you buy it at your local retail store, it's 10. If you buy it at 47th Street with cash on the barrelhead, you could probably buy them for 8. No matter where you bought them, if you turn around and you try to sell them to a pawn shop or to a jewelry store, the jewelry store is going to give you $4,000, right? That's the problem why everyone hates diamonds. And the idea of diamonds as an investment, it gets so much angry reaction because they've always bought diamonds from a jewelry store. Then you take them to a pawn shop and the pawn shop offers them 30 cents on the dollar. So what we've done is we've cut out all of that markup, even the wholesale markup. And we have basically the wholesale, a sample of all wholesale diamonds in every coin. And you can trade them for, in fact, 90% of the people who have traded their coins on our exchange have actually made a profit because they were able to sell it for more than they paid. And the friction has been less than 1% on average.
Okay, and so on your exchange, people can buy and sell, right? So yes. I could buy a bar from you today, and then I could sell it back to you tomorrow?
No, you can't sell it back to me.
Okay.
Because I'm not allowed to buy it back because that would be price fixing, right? I'm not allowed to set like a gold bullion, like Barrick Gold, they can't buy back gold. But you could sell it to a peer and jump in front of me. I can't sell to that guy walking by because you're selling to him on the exchange. So we've allowed the entire world to step in front of us. If you want to sell your bar, you step in front of us. Somebody wants to buy a new bar, they can come to Diamond Standard.
Great. So let me restate what I said, which is I can buy a bar off your exchange, and then I can sell it on your exchange tomorrow. Not
5 seconds later,
but to somebody else. 5 seconds later. Great. And I guess it's a pure exchange. So it is a little bit different from, I was sort of thinking of like buying a gold coin. You go into a gold dealer, you buy the coin, you can go back and sell the coin to the dealer, the next day. You're going to be out some transaction fees because he's got a spot price and they typically buy, only at spot they've got a premium they charge above spot. You go back, they usually don't, they'll charge you spot or sometimes a little under, kind of depends what the market's doing, but you're going to be out some single digit percentage probably in that transaction. Sounds like yours might be more efficient because there doesn't seem to be a premium to spot on your exchange.
Yeah, and there's no middleman. So our spot market is actually peer-to-peer and it's all electronic. And what you're actually trading is the token. There's a token inside every bar. So this is sitting at Brinks. Brinks holds the bars for all clients who want to trade. And you and I trade that token. The exchange has no fees, right? So you can trade your coin for free and you're actually selling it to another investor. There's no middleman to charge any kind of fees. The moment you transfer it, you now are liable for the custody. But yeah, we've made it extraordinarily efficient, but it's a centralized limit order book. So there's a depth of bids and a depth of asks. And if you want to buy 52, you're going to run through that order book and you're going to pay, $5,700 for the first one, but you might pay $5,790 for the last one. right? So it's an order book like any other securities,
Got
but
it.
it's not
All
a
right.
security.
You mentioned one or two things I think are super interesting. Real quick, can both institutional investors and retail investors buy and sell
Yeah,
on your exchange?
anybody.
Okay, so
Anybody.
anybody watching,
Yep.
they've got the money and whatnot can do this.
They could also be a market maker if they choose to. So you could have a bid and an ask, and you could try to make a spread. There's no fees, so we make it very easy to be a liquidity provider if you want to.
All right, that's so interesting. Okay, can you hold a coin or bar up again?
Well, I'll hold both. How about that?
All right, so hold it sideways if you would. All right, so the sort of metallic looking, kind of layer there in the middle.
Yeah.
You were saying that's it's a computer chip. This all ties into the blockchain is what I want to emphasize for folks.
Yeah.
Okay. So yeah, go ahead and explain that.
So inside every bar is a wireless computer chip, and it's that white layer that you can see from the side. You can see it easily from the back, right? And there's a barcode, and that's actually a computer chip and a spiral antenna around the edge. That chip does three interesting things. Number one, while these bars are sitting in a vault, you can call them up over the internet and say, "Are you there?" And the bars will answer you.
So it's like an instant audit.
2048-bit encryption instant audit that cannot be faked, but the bars will answer you and say, "Yes, I'm here. I'm safe. I'm at Brinks. I'm at JP Morgan. I'm at HSBC." So it's instant audit. Our whole system, we designed it so you never ever trust us ever. You don't trust us for the diamonds, for the market making. Everything is proven. So that's number one. The chip provides audit. It also provides authentication. If I hand this to you, you can take your phone. Your phone can analyze the chip. Then you take a picture, and you notice there's a unique pattern for every bar. The diamonds make a pattern, but there's also these purple spots in the layer, in the plastic. They're always unique. So with your phone,
it's a unique constellation. It's like a fingerprint.
It's a fingerprint. So, but more important, it's a 2048-bit encryption. But you want to see, did anybody mess with the diamonds? The third authentication is that you can see in the diamonds, and you can look for the imperfections that are noted on the certificate. So there's absolutely no way to make a fake bar if someone's willing to look at the diamonds, and you can easily see those imperfections that are supposed to be there. So the chip provides audit, it provides authentication, but the most important feature that you were mentioning is that the chip stores a blockchain token. That token is physically burnt into the computer chip, and while this is sitting at Brinks, you and I can trade the key to that token. And just like Bitcoin, whoever owns that token, they own this asset. And if you return that token to Brinks, they will give you the bar.
All right, so a lot of our viewers are probably familiar with when owning precious metals like gold. There's unallocated and allocated storage. And unallocated storage, the vault just says, "I got a bunch of gold here, and I'm giving you a certificate that says you have a claim of a couple ounces of that gold," right? But you're trusting the vault to always have enough gold there. Yeah,
we don't believe in that.
Right, I get that. Then there's allocated, and that's what we recommend people when they're investing in gold. Which says, "Hey, you're getting a claim on a coin," right? It basically says this coin or this bar, you are an owner or a fractional owner of. Bars have serial numbers on them. Coins don't. What you are doing is sort of the next evolution of allocated, where you're saying we are making these things each differentiated in a way that coins and bars aren't, or at least coins aren't, because they have no serial number. And you're saying we're giving you the ability to audit it anytime you want by just calling this thing up so it confirms that it is where it is. And in terms of trading and claims and who's got that allocation record, it's all on the blockchain. So essentially, it's the blockchain that just says, okay, Cormac just sold this coin to Adam. Adam's now the owner of it. And we know it's that exact coin or bar in that exact vault. And again, we can call it up, in a second to just confirm, in fact, that it is there.
That's exactly right. And the next step on top of that is we have the world's only regulatory license for a commodity token. So it's not just us saying you own it or the blockchain, it's a regulator. So it's what's called regulator-approved settlement. If I send you the token, you legally, and even if you're a futures contract, that now owns that commodity underneath of it. And there is no middleman. It's all direct transfer.
Super interesting. So let me ask you this, and this is just out of curiosity now. So now you've got a solution that really could be applied to other commodities. Like, why couldn't I just wrap a gold coin or a gold bar in the type of container you have there that's got the blockchain on it? I mean, couldn't it be sort of the same thing?
Yeah, there's one problem. And that's why I love diamonds so much. The moment you wrap gold in plastic, you have no way to authenticate it. You don't know if that gold is real anymore, right? But with diamonds, because they're crystals, you can optically authenticate these diamonds. You can actually get a microscope or even just a magnifier glass, and you can see the imperfections that were recorded by the gem lab. So you can be 100% certain that this is authentic, even though it's completely sealed in transparent plastic.
Got it.
So diamonds are
for the coin, you'd have to break it out, and you'd have to assay it, is what you're saying, basically.
But the moment you break it, you now break the fungibility. It's ruined. We made it easy to break. Actually, you just drop this in paint thinner, and it melts overnight. And now you have 8 GIA certified diamonds, and you can make a bracelet.
Okay. Well, and it's another question I was going to ask earlier. So let's say I wanted to buy, a couple of diamonds, I guess. How many are on the coin? 6?
8. 8 or 9. There's always 8 or 9.
Okay. Yeah, I guess it wouldn't entirely work this way, but because you'd have to buy 8 or 9 diamonds if you just wanted one. But if you wanted to make a couple of pieces of jewelry with diamonds, you could basically buy a coin, get it delivered to you, and then take those raw diamonds to a jeweler and say, right, put a band around this. You
could. I don't recommend that though, because you get 8 random diamonds. Not quite random. They'll be on a yield curve, but that means that the diamonds don't match at all. Because you're going to have small, medium, large.
So you're not going to make earrings.
No, you won't. You can never make a good pair of earrings. They'll never be a matched pair. And you'll now have the friction. You've invited the friction back into your life. Because you took out 1, you have 7 diamonds left. You're going to try to sell those 7, and you're going to get a 30% haircut.
Okay, right. All right. So let's get back to the investor part of this. So I imagine most investors, I sort of think of this underneath the Hard Assets Alliance, which is a way to buy and store gold and silver, where theoretically you could have delivery of your precious metals that you own sent to you. But that's not the main value proposition. The main value proposition is you buy it, you store it in a Brinks vault until the time you want to sell it, and then you sell it to another person who's going to keep it in the Brinks vault. The gold doesn't really move from the vault.
Liquidity is valuable.
Right. So I imagine that the vast majority of your investors that are participating in the exchange, they're just trading the blockchain token, more or less, right? The claim on the bar. The bar isn't really having to ship. It could ship, like you said, but in most cases it's not, right?
Yeah. So on average, about 94% of our clients leave it at Brinks. About 6% so far have taken delivery. We have a lot of clients who say, I'm buying 10 coins. I want 9 at Brinks. I want 1 under the Christmas tree or something.
Yeah, or in my home safe or whatever, right? Yeah.
Yeah. We actually even made a pendant. A lot of people asked us, I want to give this to my wife.
Oh.
So we made a pendant that's glass on both sides, so you can actually still use the feature set. But anyway.
So you can give your spouse some diamonds. They're just in a unique shape.
Yeah, honey, here's the diamonds you always wanted, but I have absolute liquidity.
Right. But honey, don't drop it in paint thinner.
True. Yeah, it may be a sensitive conversation, but if you want diamonds with liquidity, that's your solution. But about so some percent, like the gold bugs, which we love, we have a lot of gold bug investors because gold hasn't performed the way we all thought it should and would. Diamonds have gone up 30% in the last 2 years. So they've actually performed. And so we have a lot of gold bugs who often take delivery. But you're right, the vast majority, we made it super cheap. We don't make any money from the custody. We charge $30 per year to hold a almost $6,000 coin. And by holding it at Brinks, you have that instant liquidity. You can sell it in 5 seconds.
Okay. And this was such a fascinating conversation, Cormac. I thought this was going to be a relatively short interview. Now I'm really challenged to pack all my questions in here. You just mentioned that diamonds have actually performed very well over the past 2 years. As inflation has raged, diamonds have done quite well. So a couple of questions around that. Why do you think diamonds have done so well?
It's all about jewelry and supply and demand. And so during COVID, you had a lot of the mines shut down because they had outbreaks, and they had to create all these, safety protocols.
Right. You couldn't have people crammed into a mine because everybody was going to catch COVID. Yeah.
Exactly. But at the same time, you had all the consumers at home who are not going to restaurants, they're not going to sporting events, they're not going on vacation. They were buying jewelry online. So we had a drop in supply, and we had a spike in jewelry demand that really came, a lot of it came out in 2021. So there was a big jump. So now what we see is that Russia has been sanctioned, and they supply about 30% of the world's diamonds. We can't buy diamonds from any Russian suppliers. And so that's been a knock-on effect that's reduced the supply. But the longer term macro is really what's most interesting about diamonds. They haven't discovered a diamond mine in 20 years. And the annual production has been steadily declining. And it's projected to continue to decline by 2 to 4% per year. In the meantime, demand for jewelry has grown in every global market. It's slowed down recently in China, which was the fastest growing market, and still US is number one. But jewelry demand is expected to continue to rise by 4% per year on average. So you've got this, kind of macro supply demand dynamic. Supply going down, demand going up. What happens to prices?
Right. They should go up. Okay. So just a couple clarifications. So you're talking about natural supply of diamonds, right? So I do want to get back to the lab grown topic in a second. And there have been a couple things that have given special tailwinds, right? The pandemic, which now is hopefully mostly over, and Russia supply going off the market.
Now the tailwind is us.
Well, that's what I want to get to in 1 second. So on the putting on a pessimist's hat just for a minute, you could say, look, maybe you sort of pulled demand forward for a little bit, right? People bought a bunch of diamonds while they were sitting home during the pandemic. You had this shutdown in annual production that's now coming back online. A lot of people I talked to on this channel, you just said you watched the Jim Rickards interview, expect recession, deflation perhaps coming ahead. That may crimp consumer spending for a bit. We're not talking about forever, but we're talking maybe the next year or two could see lower consumer spending. So maybe that's the pessimistic outlook in the near term. But what I believe you're going to go to, and let me toss it out there, and if I'm wrong, correct me, is you guys have now created this marketplace that institutional players can now play in where they couldn't play in before. So there's going to be a ton of new capital coming into the space, and that will rise prices.
That's exactly right. And so that's our investment thesis in a nutshell. So I want to show you one more chart, which I think you'll find very interesting. This chart shows the percent of holdings that investors own of each precious metal. And as you can see, gold is off the chart. 30% of all the world's gold is owned by investors, including central banks. But for silver, platinum, palladium, even rhodium, which is not on this chart, the investors of the world own at least 15% of the above ground supply of each precious metal. For diamonds, that number is closer to between 1% and 2%. I'm not counting all the jewelry in the world. Jewelry is not an investment, but I'm talking about the way you have palladium bars, asset backing ETFs. All of that adds up to about 15%. What's going to happen now is a secular one-time phase of position building. And these institutional investors are already beginning to allocate to this asset. And look how attractive it is. Number one, it's a hard asset, right? It's not a liability on somebody else's balance sheet. It can't go bankrupt. It can't default. It's a hard asset you can own. So you have this natural inflation hedge feature. But diamonds have also been extraordinarily uncorrelated. 0.05 correlation to gold, 0.06 correlation to stocks. And by years as a quant, I've never seen another asset that has near zero correlation to literally everything else.
Right. And sorry to interrupt, but I know a lot of fund managers who would love to have had an asset like that in their portfolio coming into 2022.
Yeah. And they don't even know about the vol, which is 3%. 3% vol asset with zero correlation, and it's had 30% return. And we think that's the IRR that we expect to continue as investors build positions for the first time. And there's one magical inflection point that we're looking forward to, which is diamonds are not in any of the commodity indices, but they're a natural resource that's worth more than all of the silver, all of the platinum, all of the palladium, rhodium, uranium combined. And so commodity indices are strictly based on their volume of secondary market trading. So once the secondary market trading exceeds, I can't remember the benchmark, diamonds suddenly get added to Goldman Sachs, Bloomberg Commodity Index with a weight above silver. And so in one kind of swing, you're going to have sovereign wealth funds, pensions, endowments, many of whom allocate 4, 5, 6, even 7% to commodities. Overnight, they have to buy diamond, which they'll probably buy through an ETF or less likely the futures contracts. So what we've worked on for the last 2 years is we've been launching all of the financial products that already exist for gold, we've been creating for diamond. So we already have approval for futures, which are being listed on CME, Globex, through the MGEX exchange. We already have approval for options, which are being traded on the MIAX exchange. We've already filed an S1 for an ETF here in the United States. And we're developing a listed product in Canada, which we think will actually be the first listed product that launches.
That is super fascinating. And so is the general sort of value proposition to the folks that are listening here right now is, hey, there's a much more efficient way to buy diamonds now, buy and hold diamonds as an investment. And there's a big optionality part of that at this point in the timeline where there could be a catalytic event that's going to reprice all diamonds higher. So in other words, This is kind of an especially good time to be getting into a product such as yours because of the expected repricing event.
That's right. And there's a building curve that has to take place. For example, a firm like a PIMCO or a BlackRock, their checks are $50 million and up. And they can't own more than X% of the float of an asset. So they're kind of waiting for the float to get to a certain number before they can participate. A lot of investors can only own listed products. They can't own a commodity, for example. So you have a lot of the biggest pools of money are extremely interested because we meet them every day. They see the correlations, they see the return, but they can't touch it because of the packaging. They need to wait for the ETF. So all of our investors now are macro traders, FX traders, hedge funds, self-directed investors who want to buy and hold. And they all understand this thesis that this financialization of diamonds begets demand. That demand will invariably impact the price significantly. And look at what happened with uranium, right? About a year ago, we had a couple of uranium funds with the Sprott and the Yellow Cake. And those funds accumulated almost $4 billion of uranium over a 9-month period. Now, that doesn't sound like that much compared to the uranium market, but that was a large chunk of the available float. And uranium went up tremendously as a result of that financialization. We think that happens with diamonds now.
Okay, got it. And do you feel that the solutions you're putting in place and the exchange you've created has enough volume that you can create vehicles that are big enough to qualify for these larger institutions to buy into?
So we're building right now our second assembly facility, actually right here in New York. People find it hard to believe. It's going to be public, so people can visit. That facility has a capacity of 4 billion per year of product assembly. And our exchange currently has 10 billion of diamonds listed.
Okay. So the depth is there even already, which is great.
Yes.
And super promising. Okay, so you also have something in addition to your coins and bars, you have an investment offering, something called the Diamond Standard Fund. How does that differ from the ETFs that you're talking about, and what exactly does the Diamond Standard Fund offer to investors?
So the vast majority of our clients, they're buying the commodity. And if you're a self-directed investor or a trader or a gold bug, that's not a problem. If you're an RIA firm, or if you're a metals and mining fund, you generally don't have a mandate that allows you to hold physical commodities. And so we had hundreds of clients ask us, can you make a fund? So we made a very efficient fund. We partnered with Horizon Kinetics, which is one of our larger investors, great contrarian investor. If you're interested in Murray Stahl, just a genius. He was an investor in 3 Mile Island after the emergency there. So he jumps in where other people fear. Anyway, so we created Diamond Standard Fund. It's very simple. It sells subscriptions and it buys and holds the commodity. And it has a third-party administrator, it has an auditor, and it has a daily NAV. But it's an unlisted fund. The shares will become tradable on the OTCQX in about 11 months. You have to hold them for a year. So it's just an efficient vehicle for people who cannot hold commodities directly.
Okay, like I assume an IRA, right?
Exactly.
There are issues holding physical commodities directly inside of a retirement account, but it sounds like they can own shares of the fund, and
exactly.
That's okay.
I think probably many more than half of the investors in Diamond Standard Fund are IRAs and RIAs, the two.
All right, fascinating. Look, I've got a ton more questions for you, but we're hitting on the hour limit here. Let me try to land the plane here as best I can. I have talked a bit about the lab grown diamonds, the synthetic diamonds. You mentioned that folks are in your ecosystem have actually it's been an incentive for them to want you to be successful with what you're building here because of the threat. So I guess let's just talk about that for a second. So what is the threat of lab-grown diamonds here? Is it an infinite amount of flawless diamonds?
Well, the good news is they've had synthetic sapphires and rubies for 50 years, and it hasn't impacted their value. Fortunately for us and investors worldwide, it's very easy to detect a lab-grown diamond. The Gem Lab knows it instantly because they're chemically identical, but they're not physically identical. Natural diamonds grow in layers over literally hundreds of thousands of years. Lab-grown diamonds grow over weeks. So it's obvious to a lab. We only use natural diamonds. And looking at the price and demand for diamonds over the last 7 years, which is how long synthetics have been around, these lab-grown, demand for diamonds has consistently grown pretty much as it has for the last 20 years. And demand for synthetic lab-grown diamonds has also grown, but it's obviously from buyers who would not have bought natural diamonds. So they're finding a new client that's really interested in jewelry. But the other thing that's interesting.
Sorry to interrupt. Are those for the synthetics? Are they jewelry buyers, or are they like industrial buyers that are looking to get a diamond hard substance? No. Okay.
Well, synthetic have also replaced industrial diamonds. Industrial diamonds they were only 1 or 2% of diamonds, and they used to be the chips and the shavings. Now it's easier to grow the industrial diamond you need because it's so small. They can grow it very quickly. But it's the demand for jewelry, and it's becoming more fashion jewelry. So the average price point of a lab-grown diamond jewelry is a fraction of what it is for natural. But what's happened with the price of synthetic diamonds is exactly what you would expect. Since you can just print these diamonds, basically, the price has fallen 80% in the last 4 years. You could never resell a lab-grown diamond probably for anything. There's just no secondary market. You could always sell your natural diamonds for something. So the value proposition of, now a natural diamond is over 10 times, if they're identical, 10 times a lab-grown diamond. And we think that continues to where lab-grown diamonds are kind of like, a fake necklace. It's nice to wear, and then you throw it away.
Got it. Okay. Yeah. Interesting. I'm sort of thinking about it sort of like tungsten versus gold, which is you can make bars and coins out of both of them, but one is naturally rare, and they share a lot of the same properties that you would want in a form of money. But gold is just much more rare in the world than
gold
tungsten.
Is pretty.
And pretty. But a synthetic diamond versus a real diamond, it's the geological scarcity of the natural diamond that keeps its price protected from the infinite printing of synthetic diamonds. That's
right. As they say, real is rare. And it's held throughout history that people want things that are real and rare.
Okay. And so one of the questions I had was about sort of the cartel, was it going to sort of, is the empire going to strike back here? But it sounds like you're a purchaser of theirs. So the De Beers and stuff of the world, since they're selling to those 300 guys and you're then taking from those 300 guys, you're not really a threat. Is that accurate?
Oh, no. Yeah, absolutely. They love us.
Yeah.
Now, we were very careful. We didn't accept, we were approached by a lot of them. We didn't accept a penny from any diamond company like that. But they love that we're creating demand for everything they dig out of the earth. The other thing that Anglo-American loves is that we're creating a futures contract that they can use to hedge their inventory risk because they're long diamond. And Tiffany's too. Tiffany's is long diamond. They have a huge, multi-billion-dollar position in diamond, that for the first time they have access to hedging vehicles like futures.
Because there was no futures market, which you're now creating.
Yeah, they have futures for every other thing they dig up. Anglo-American is a giant mining company. But the key thing is that there's no stockpile. They have no ability to manipulate the price, to dump. They just don't have stocks. They sell what they find every 3 months. And so there's no way for them to have any impact. The other thing I'll mention is, I mentioned that diamond supply is diminishing, and we expect to buy 15% of the supply. There's only 1% stock to flow. That means we'd have to buy 15 years of production, 100%. There's no possible way we can do it. So the last part of our business is that I mentioned we're building this new facility. We're also building our first recycling facility where we're going to start buying the majority of our diamonds from consumers, because we're not going to be able to buy them from the mines without destroying the jewelry industry. So we think it's a big ESG play where we're paying a dividend to society by liquidating these non-productive assets that 1 billion households own. Either they
So we've got grandma's old brooch that nobody wears anymore. Now you can actually get some money for that, and you guys are recycling a diamond that doesn't have to be dug out of the earth.
Yeah, and we're not paying the way a pawn shop pays. We have an exchange. We pay fair market price.
Wow, that's super fascinating. All right. Well, Cormac, look, this has been a really, really interesting discussion. Really appreciate you giving us so much detail on what's going on here. It sounds great. So first off, wishing you the best of luck with this endeavor.
Thank
For
you.
folks that have really enjoyed this discussion, getting to hear what you guys have created there at Diamond Standard, what you're continuing to build, where can they go to learn more about you and your offering?
Well, you can look at the 5 Wall Street Journal articles, but diamondstandard.co is the repository for all of our research. It's where you can buy the commodity at the spot price. We don't set the price, and you can access the fund and all of the research that we produce.
Fantastic. And if folks want to buy something today, there's the ability to do that?
Yeah, diamondstandard.co. You'll see the spot.
All right. Well, look, thanks so much, Cormac. I'm sure we're going to have a lot of interest in the comment section here of this video. Would love to have you back on in the future to address some of the questions I couldn't ask, and I'm sure the many questions that our viewers are going to ask here.
It'd be my pleasure. Thank you, Adam.
All right. Thanks, folks. And if you've enjoyed watching this interview, do us a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Cormac, I can't thank you again. Thank you enough again. And everybody else, thanks so much for watching.
Thank you. My pleasure.